In this panel, we'll be discussing the rapidly changing electricity sector and how utilities are being forced to reconcile with deep decarbonization, significant increases in variable renewable power, decentralized and distributed business models, and digitalization across the electricity supply chain. What are the challenges for collecting, storing, and distributing clean power, and what kind of flexibility resources do we need? And what are the short and long-term cost implications of leveraging new technologies to deliver cleaner and smarter energy systems? So for all those great topics, I'm joined here by three esteemed panelists. Joe Hamrock is president and chief executive of NiSource, one of the largest U.S. regulated utilities. Ida Kettleborough is Deputy Director of the Energy Transitions Commission, a think tank representing a global coalition of energy leaders committed to achieving net zero. And George Bilicic is Vice Chairman, Global Head of Power, Energy, and Infrastructure at Lazard, an international investment bank with over 245 billion in assets under management. So let's dive right in. And let me start with you, Ida. At the ETC, you work with policymakers and business leaders to help speed the energy transition to a net zero carbon system. And electrification is clearly going to play a major role here. Can you please set the scene for us and talk a little bit about the scale of global power system expansion that we need to reach a net zero economy?
Absolutely. Thank you so much for having me today. Yeah, at the ETC, we have spent a lot of time really developing our vision for what a net zero mid-century economy could like. What is the shape of that economy? And as you've alluded to, that is really a deeply electrified economy. We believe it's by 2050, electricity use could grow 3 to 5 times globally. So from today's around 27,000 terawatt hours to 90 to maybe even 130 terawatt hours, depending on the assumptions you make around the role of energy efficiency improvements and the role of clean hydrogen produced via electricity. And that's actually electricity representing between 60 to 70% of final energy demand versus the 20% it already takes today. And so really transitioning to electricity as the main source of final energy, we think represents the cheapest and most efficient way to decarbonize the global economy.
Great, thank you. And so, if we're going to be looking at this big increase in electrification, obviously, power utilities are at the forefront of delivering that. Joe, your company is one of the largest public utilities in the U.S., operating across 7 states. How can we ensure that a transition of the energy industry in the United States of the scale that this kind of electrification trend is going to require, how do we ensure that delivers sustainable energy, but also brings along, workers and communities and some of the most vulnerable populations?
Yeah, well, thank you. And first, Philip, I want to thank you and the team at The Economist for your work bringing people together in this format around this critically important discussion. And thanks to Ida and George for your work on these issues as well. And maybe just a little bit more framing of our company, just to ensure understanding, given that this is a global audience. NiSource is, as you said, publicly traded utility providing gas and electric service across 6 states in the U.S., more than 3 million gas customers, and electric service in 1 state, in Indiana. And we're currently executing one of the fastest and deepest decarbonization plans in the country, expected to reduce greenhouse gas emissions by 90% before 2030, with much of that achieved by 2023. And so from the work we're doing and the lessons that we're garnering from that work, I can share that what's really important here, and no disagreement with Ida, we see electrification as a key driver of this. We also see that shifting to this new energy paradigm is such a complex process, and we've got to balance the needs of all of the stakeholders and take into consideration the potential impact on local economies. And as you noted in the framing of the question, people must be at the center of the focus, and the people in particular who have dedicated their lives to serving others across this industry, and the people we serve, especially the most vulnerable, who may struggle already to access affordable energy, and for whom this clean energy transition can be simply daunting in its complexity and ultimately in affordability. And those are some of the key constituents in the so-called just transition. And I don't think I'm overstating it to say that we'll fail in the clean energy transition if we leave people behind and out of the solutions, meaning helping the workers transition, helping them transition from the economy related to the fossil industry, coal in particular, into new energies in the new jobs in the clean energy economy. And we believe that's an important role for our industry. And it's very much how we've approached the closure of our coal plants that's driving our decarbonization strategy. I'll just add that I recently had the privilege of participating in the Vatican's third dialogue on energy transition, the theme of which was the just transition. And based on these discussions alone, I'm really encouraged by the level of commitment that's emerging around the globe to appropriately deal with these challenges, and the recognition that the key to the transition is indeed to support the people who are most affected, both by climate change itself and by the energy transition that we're all a part of here. And I can go more into some of the techniques we've used to manage the transition in our local economy, but it's a critically important part for us, particularly for utilities, to play in this transition.
Great, absolutely, and I look forward to talking a little bit more about sort of the steps that you guys are taking. But maybe George, I can ask you. You know, you've taken part in billions of dollars of power infrastructure investment. You know, with Lazard now, previously also with Sempra and KKR. How do we mobilize the kind of financing that's required to sort of carry through the major lift that both Ida and Joe were just referring to? Undertaking the technology investments we need to deliver the electrification on that kind of scale, and also all of the potential impacts on society and the other investments that we need to make with our existing infrastructure.
So it's a great question, and thank you for arranging this at The Economist, and it's a pleasure to be with my co-panelists as well. I would say first of all, in this environment, one of the problems that we don't have is finding money to finance infrastructure. As long as we're in a regulatory or underlying legal framework that provides some reasonable certainty of some acceptable return. And that acceptable return for the infrastructure investor or the strategic company is widely understood to take into account the risk. So these would not be returns that would be identified as being unreasonable. They would be taking into account the risk. The other thing that's important in the infrastructure area is we find that with this increasing focus on the stakeholder compact that companies need to have and pools of capital need to have, as opposed to just a shareholder impact, that there's a reality that's set in around pools of capital, strategic companies that have the capital, that the return needs to be reasonable and take into account the interests of all stakeholders. I mean, without question, the way NiSource deals with its stakeholders and its jurisdictions is right on top of that focus on stakeholders. There is also, so infrastructure in some ways is easy right now, and at some point there will be intermittency in the capital markets, which will be more difficult, but that's not something that we see in the near to medium term future. In the technology area, there are incredibly interesting pools of capital sitting at regular companies or sitting in pools of venture capital or impact investing pools of capital seeking to invest in new technology and scale it. For some technologies, there still is this, there was a term that was used in the last big clean energy investing wave called the Valley of Death. And there is still an issue with some technologies that may seem promising that relate to how one attracts the capital to scale before the revenue or the market has been built. And I think we'll see that sort of thing in the green hydrogen area. We may see it in some of the renewable fuels areas where there may be pilot projects that are assembled that work, but to scale them is going to require a pool of capital that is not as easily assembled as would be the case in the infrastructure area. But in summary, I would characterize this as an area where there is a lot of capital chasing investment opportunities. Some pools of capital might tell you that that's part of the problem because they can't find places to invest because there's so much competition. And there's a lot of capital looking to drive innovation and technology. And the last point would be just that the government has a role to play in some of these areas as well. So the Department of Energy in the United States has been remarkably impactful in my career in identifying new technologies to support and grow. And that's surely the case in other countries as well.
Thanks so much, and I'm glad that you brought up sort of the role of policy. Maybe Ita, I can bring you in here. There's such an emphasis on the kind of variable clean generation technologies like wind and solar that we all know. How can policy provide sort of appropriate incentives for renewables deployment at scale, including things like power market design that can help to build those out and those are the technologies that we know, but how can policy also support going forward some of the more the technologies of the future, whether that is hydrogen or some of the other sort of over the horizon technologies that George mentioned?
So I think thank you, really really good question. I think that the key thing for the scale up of wind and solar, which for us is really the bedrock of this vastly electrified economy as the cheapest form of generation. And we have really seen in the last decades the costs of renewables kind of falling beyond anyone's expectations, beyond the forecasts from a decade ago. And so really that declining cost means that we can achieve the decarbonization of the power sector while simultaneously scaling the power sector, which is not an easy task, at a cheaper cost than we ever thought, by transitioning towards wind and solar. And we're talking about massive deployment of wind and solar. We're estimating that it could be, a 5 to 7 times growth in annual installations of wind and solar by 2030 and 10 times installation by the 2040. So really very radical, huge scaling of finance into that in those technologies. And I think that the key thing for us in terms of how do we incentivize, the story historically with renewables has been renewables need subsidies, and that has driven those subsidies, that proactive support from government has driven those cost declines I've talked about. But now we're at a stage when actually these are cost-effective technologies, as George just mentioned. They provide returns that are attractive, and we need to kind of, now what we're looking at is how can the policy environment make it attractive to deploy at scale. And we think there's kind of two really critical pieces of that. The first is really clear quantitative targets for grid decarbonization and renewables build out. So giving industry the confidence that, for instance, new renewable projects or project auctions, for instance, and that's often how it's developed in Europe, are on the horizon. So we've seen that in the UK. The government has announced a kind of 40 gigawatt target for 2030. That's really helpful for giving the certainty around investing in upcoming projects. So that's one, the kind of clear medium-term targets, ideally embedded in law or with a legal backing. The second is that appropriate incentives for this deployment at scale. And this is about ensuring that not that renewables get long-term funding, long-term subsidies, but that the way we structure our markets enables a low cost of capital to be, and therefore makes it as cheap as possible to deploy this build out. And really what we're talking about there is long-term contracts, but long-term contracts that are well designed so that they still can reflect the short-term market needs, and you don't bring on wind and solar capacity that is not enhancing and meeting your short-term system dispatch needs. So what we're really talking about here is long-term contracts that are competitively auctioned, that guarantee a certain strike price that investors can then depend on for the life of that project, but that those prices, we don't believe that will enable a long-term subsidy for wind and solar. Indeed, that will still be the cheapest form. So it's just structuring the way that we purchase wind and solar to enable finance really to flow in.
Great, thank you. Joe, you're the one that's making these kind of investments. Talking about these different generation technologies. What are some of the hurdles that you might see, or what do you see as the relative cost competitiveness of those various options? And what are sort of the market structures that you think need to be there so that you can feel right about making the kind of investments on the scale that you're just talking about?
Yeah, so you're right. We live at the intersection of the policy and the capital markets and the customer and the implementation. And I like to say we're routinely making 30, 40, 50-year bets in a 2 to 4 year policy window and maybe a 3-year market window, because you just can't see that far out. And so what's the real lesson for us in the transition that we're in is that trust is the essential ingredient. If you take this intersection with literally every stakeholder having some interest in the solutions, the key for us is to leverage what I think is true of all utilities. We're uniquely positioned to build and enhance trust among our stakeholders. That obviously includes customers, includes our community leaders in the communities we serve. It includes policymakers, suppliers, certainly our employers, and ultimately, in our case, the regulators who either approve or disapprove of the plans and the investments we're making. And so using this transition as a platform to make sure we bring stakeholders together, not so much with the answer, but with the question, and to frame the right question. And the way we've done that, and I think this is really demonstrated, deepening, it's never a perfect solution, but it deepens trust with our stakeholders, is when we entered the planning process, the integrated resource planning process for the transition that we're now well into, with our coal transition well underway and our renewables build out also well underway, and the necessity approved by our regulators for all of our new projects, all of our new renewable projects. The approach at the beginning, 3 years ago, for a transition that'll take 5 to 10 years, was to put all of the options on the table, not to start with only one answer, but we actually executed a transactable request for proposal for new capacity to replace the retiring coal units. And we took bids that either we could build and own, or that we could purchase power from the providers. And there's no doubt, to Ida's point, that the policy environment shaped the answer. The renewables as the most economic answer in our transition were a direct result of federal tax policy in the U.S. And so that actually aided this transition in a very constructive way. It's critical that the policies are sound and drive that. The second piece to your point about the market structures, understanding that we're solving for reliability, resiliency, affordability, and environmental impact. All of those variables have to be in a balanced equation that looks across time at what we're actually solving for. And I can tell you that people came in with very different ideas about the answer, about the right answer, the best answer. But at the end of the day, everybody saw a very transparent analysis with transactable proposals in the mix. So there was no, that's your version of what it's going to cost. There was none of that bias in it. It engendered a deeper understanding across all of the stakeholders that I think built the trust to enable the transition that we're now in. So bring that forward. We're now in that process again, looking out at the next stage of our transition. And one of the things that's happening, and this is to Ida's point, and I think somewhat to George's point as well, we're starting to see at the level of saturation that we now have in our plan for intermittent resources and the need for storage, particularly to meet winter peak demands. Electrification is a really total electrification is a really challenging trajectory with 100% renewables and storage to supplement the renewables. And what it sets up is, I think, a critically important point, and Ida touched on this, the role of hydrogen in the long term, but importantly, the role of natural gas infrastructure as a capacity resource for even an electrification strategy. So as you increase the amount of electrification in northern latitudes in the northern hemisphere and southern in the southern hemisphere, we're going to see the limits of storage and the limits of renewables. And we're already seeing it on our winter peak days in the planning that we're doing, which means there's a way to think about natural gas infrastructure, separate the infrastructure from the molecules as a capacity resource, as a giant battery, a giant storage reservoir that can flow an increasing amount of renewable natural gas to help with the methane problems from agriculture and waste, but also ultimately with a hydrogen blend. But that can supplement electrification and provide locally placed electric resources with a gas feedstock, and or provide peak demand support for winter heating loads themselves from a direct use of natural gas that can be decarbonized. So we think what's really emerging now is an all of the above strategy is critically important if we're going to continue to drive that trust and enhance that trust and make sure that we're leveraging in a conservative way the resources that are already available across our economies to make sure we meet these peak demands. So trust as the foundation, but an all of the above solution set that allows us to move through this, keeping options open as we go forward.
Thanks, Joe. I mean, it really sounds like, a panoply of technologies that are working together, both the ones that we've relied on for many decades in the past and also some that are coming over the horizon. George, Lazard has noted sort of wide variations in cost curves for different clean energy technologies. Annually, Lazard famously has their levelized cost of energy analysis. What are some of the sort of biggest investor risks that you see in the context of these rapidly changing technology costs, and a little bit like Joe mentioned, the kind of enabling technologies that might be using gas infrastructure with hydrogen, biogas, or low carbon gas and different kind of storage technologies to be able to really get those other manage variability on the grid, for example.
So I would say just on the cost trend, we've been observing this for a long time, and we could see this based on the cost composition of utility scale solar in 2008 and 9. That there was no way that with scale the costs weren't going to go down, and in fact they have gone down. Costs for wind have gone down. The levelized cost of wind has gone down as capacity factors have increased, and folks have gotten better at building these projects and things like that. I'd say in wind and solar, with the right underlying regulatory regime and contract regime, there isn't a lot of investor risk. As long as the project is built on time and on budget. I don't want to say there's no risk, because there is some risk, but it's not an area where we are worried. We would be worried about investing in projects where people are taking a bet on the market and they're buying these things using a U.S. term or building these things on a merchant basis, betting on prices in the future. That's where folks can get in trouble, and so that's something to have in mind. Storage is an increasing presence in the United States and elsewhere, but the same observations can be made about storage. If the project is well designed in a regulatory environment with some certainty of cash flows, the investors should target a pretty low return given the risk profile. Building those, betting on future prices, trading around them, things like that, that's a different proposition. For some of the newer generation technologies or hydrogen or things of that ilk, there's a different investment risk calculation because of the still uncertain nature of some of those technologies and the high cost nature of those technologies. We have also put out a study on storage and hydrogen. All of this is available on our website. What it looks like to us in the case of hydrogen is we would be betting on the same kind of cost trend that we saw in solar PV over the last 15 years. If you look at the capital costs and the efficiencies of the hydrogen projects we've studied, it seems to us as those projects scale and there's more of a presence of hydrogen in the economy, those costs will go down. One thing that is also related to all of this, particularly in the United States, but also elsewhere, is how critically important transmission is to the energy transition. And there's a lot of discussion about whether subsidies are needed and things of that nature. But certainly in the United States, we have a massive permitting problem. We have a massive problem with a lot of stakeholders having the ability to express a point of view on transmission. And a lot of transmission we really need for the next generation of wind projects in particular. It's just very, very difficult to build. And we need to solve that. And it's a pretty basic problem. It's a permitting problem. It's a stakeholder coalition assemblage problem. But that needs to be addressed. That really has nothing to do with costs. And I would argue there isn't a subsidy that's necessary for that to be successful. It's really it's a permitting and coalition building exercise.
Absolutely. I mean, maybe Joe, I can pass that back to you. How do you think about the value of grid investments? How do you work, for example, with transmission operators to make sure that you can sort of deliver the energy that you have, and how do you make sure that that build out is commensurate with the kind of business that you want to run?
Yeah, and I agree with what George said. We are a transmission operator, and one of the key issues for us, and this goes into the role in the United States of the regional transmission organizations that do large area grid planning and integrated planning on the generation and transmission basis. And it's the set of rules there is critically important, that we have clear market structures that incent in a balanced way both generation and transmission investments. In our case, what we've done as we back to the transactable proposals that we introduced in our planning process, we expect those all to bring transmission with them. And those are vetted and verified as viable pathways and alternatives. But you've got to build some diversity into the portfolio, because any one of those projects can run into the kind of impediments that George noted. And the same is true for gas pipeline siting. So it's not unique to electric transmission. If you think about the energy infrastructure needs, and specifically in the US in our case, that coordination ultimately becomes, and I think this is right back to my earlier point, ultimately becomes a local issue. And so the ground game, so to speak, the local relationships that either the developers have, the transmission developers, if they're utilities or if they're competitive transmission owners, and that the renewables or other resource developers have, is the key to the whole siting game, because it's ultimately the ability to work with the communities that breeds the success of this transition. And it's right back to the trust issue. We've seen that. We've worked with some world-class partners in the transition that we're in. And what we've seen is they all bring a very healthy engagement model at the local community level, where they're either building wind, solar, or bringing a transmission investment. Sometimes that's us as well. But it's so crucial that we have a clear set of rules, a clear framework, siting authority that's appropriate, but also the developers, us ourselves included, have to manage those relationships.
Absolutely. Great. Ida, we've talked a lot here. We've talked about generation. We've talked about transmission systems and sort of the distribution side of this. Now I want to talk a little bit about sort of demand and demand response. Energy efficiency has a significant role, as a grid balancing option. But it's also, something that is going to be sort of enabled by artificial intelligence and by digitalization. How are these technologies and energy efficiency, changing the way that consumers interact with utilities and how utilities, manage the energy system?
Indeed. And when we think about some of the challenges that we've touched upon, the grid balancing challenges, the energy system balancing challenges that Joe talked about in terms of as you increase the penetration of your variable renewables, how do you balance the balance supply and demand over daily, hourly, daily, monthly, seasonal balancing challenges. The potential to use kind of demand side response and smart charging, smart interaction between users of electricity and the grid itself is a huge opportunity for making the challenge that is a very real challenge of balancing the overall kind of renewables dominated grid and reducing the scale of that challenge. So you can use energy consuming technologies to move your energy need around the day. So, this would be your classic, EV charging or using heating, hot water tank heating in homes that would allow you to say, well, the wind is blowing really hard at the moment. The sun's been shining. We've got a lot of extra power on the system. We really want everyone to be charging and using electricity now, because then when that is not happening, when the wind stops blowing, when it's a cloudy hour, we don't need to be drawing power from the system. So that kind of domestic demand side response is a really powerful potential lever. I think one of the things about it is a lever that people have mentioned for a long time and hasn't necessarily materialized. So there are some really key enablers for that to happen. So you have to have technology that is smart enough, but also a distribution grid. And that this is really critical. What we're really talking about is upgrading our local distribution networks in many cases to make them much smarter, to make them two-way rather than one-way, to make them be able to react to the signals at the overall system level. So that's a kind of one set of technologies that we can use. There's also industry response, and we already have industry response in many countries. It's already a tool that's used, but using that much more systematically and actually having market structures that enable you to pay industry players for not just necessarily through discounted rates, but actually really trading that ability to change when they use their demand. And also we've talked a lot about hydrogen. I think hydrogen is one of those very exciting opportunities, green hydrogen in particular, where we can have a kind of symbiotic relationship between the growth of massive electrification, growth of a renewable dominated grid with cheap power available at certain times. And this is especially as the costs of hydrogen capex continues to decline, that we're going to be able to respond in terms of green hydrogen production. And then, of course, the green hydrogen that you can produce, it is then an option, as Joe took us through, to think about storing that and then potentially blending or burning that as 100% H2 to produce energy when we do have these when we have periods with high demand and low supply. And that is there's questions around that. There's local dynamics in terms of what might the right balance be between that. It's a relatively inefficient way of generating power to take it from wind and solar all the way to hydrogen and then back to electrification. But to meet some of these really challenging long-term seasonal balancing challenges, it could play a really critical role. So really, I think across there are a lot of different ways that the demand side can actually start to play a greater role and reduce some of the challenge as we transition to a lower carbon grid.
Great. Joe, active demand. We've spent billions of dollars, distributing smart meters to households, since after the last global financial crisis. But utilities weren't always using all the data at their fingertips. How do you sort through all of those new reams of data to sort of change the way that you're interacting with your customers and finally to deliver sort of more sustainable services at the end?
Yeah, so I agree with Ida. There's a great promise here, and there's almost a leapfrog opportunity to an entirely different generation of how we plan and manage both distribution and transmission. I started my career as a distribution planning engineer and wouldn't have even envisioned these, and that just says how old I am. But the real key here is ultimately the consumer, because we're talking about usage patterns, either giving proxy to somebody to manage that for you or technology to manage that for you in a way that's very foreign to many consumers. And I've got some experience in that with some of the smart grid endeavors we've undertaken throughout my career. And ultimately, the unlock here is the technology at the premise level that allows a customer to dial in the level of comfort, the level of trade-offs they want to make, and the level of autonomy that they want to give to the systems that manage their energy. It only works if you unlock that code. And I think technology today is now at the state that that's actually a real promise and a very real reality. The one thing I would add is this goes back to the earlier point about the just transition. There's a very real risk of a digital divide here. Vulnerable communities that just already don't have access to that level of technology or complexity, and we've got to take great care to not leave them behind. And they tend to often live in older housing stock that is greatly in need of energy efficiency upgrades. So there's a programmatic way to approach this, but it's both at one level a leapfrog to the next generation, but also a challenge to not leave people behind, a fairly significant population in many parts of our country that we want to make sure that we're bringing everybody along on this transition. And we think that's key for not just utilities, but the policymakers have to find the key to supporting everybody through this transition.
Fabulous. Thanks so much, Joe. We're just about out of time here, but I just want to throw one last question to George. We've been talking here about the role of digital technologies. We haven't gotten as much into sort of distributed energy and the role of prosumers and individuals that are really at the heart of this energy transition. But I wanted to know, in the context of all of this changing, Lazard has talked about in the past, concern about the viability for significant returns for traditional utilities. So maybe I just want to ask quickly, what is the outlook for the traditional utility business model, and how can it evolve for the better in the context of these massive changes at the distribution level and in terms of sort of technology and digitalization, how we deal with consumers?
I'd say through the lens of the United States utilities, the best way to invest in the energy transition in this market is to invest through utilities, or to be a consumer benefiting from what is being put through the utility system. There's a lot of other ways to do well if you're an investor, but we see a lot of the value being captured in a reasonable risk return balance, taking into account stakeholders in the utility system. And the utility system in the United States is the most efficient way to affect the energy transition in our judgment. So utilities are going to be great. We think consumers are going to benefit because costs are going down, and the utilities and the partners of the utilities are going to deliver what the consumer wants, ultimately in a reasonable way, because it must be done that way to preserve the stakeholder compact. Then we think there's going to be a bunch of other market participants that do quite well in the United States and globally. So one business that we like a lot that relates to the demand management discussion we were just having in the energy efficiency discussion is a business that broadly focuses on decarbonization services and goes to the large commercial and industrial user and has the capability to provide a holistic decarbonization solution, and then maybe is vertically integrated in a couple of those service areas. And so, for utilities, we think they're going to be in good shape, and this is beyond the time we have here, but the gas LDC system in the United States is a necessary part of the all of the above, or the new all of the above solution, and we see that as being an enduring part of the system, a facilitator of the energy transition, whether related to renewable natural gas or or hydrogen, and as new technology becomes efficient.
Great. Well, that's, I think, a great place to end here. Proliferation of new market players that are obviously engaging with, new technologies, but also, existing incumbents in the market using existing incumbent technologies, for example, like the gas transmission network, to introduce, new, forms of flexibility onto the network, all at the service of enabling sort of consumers and making sure that we have a just transition here. I want to thank all of you three for a really great conversation today. It was a pleasure to have you with us. Joe Hamrock, Ida Kettleborough, and George Bilicic. Thanks for all your fantastic insights. And thank you also to our audience for joining us. That brings us to the end of day 3 of the Countdown to COP event. Please join us again tomorrow when we will be covering the UN Decade of Ecosystem Restoration, Sustainable Agriculture, and Future Cities. It's going to be an exciting day. So join us tomorrow. Thanks very much.